You can now buy a piece of $1 million apartment for less than the price of a takeout dinner and trade it like an altcoin on your phone. Real-world asset tokenization is reshaping traditional real estate, letting investors earn passive yield through smart contracts on Solana and Ethereum. But is this the ultimate Gen Z wealth builder or an overhyped liquidity trap? For Gen Z, the appeal is obvious. Home prices are high, mortgage rates remain expensive, and building a deposit can take years. Young investors are locked out of an asset class that has created generational wealth, while inflation reduces the value of cash sitting on the sidelines. Tokenization offers a different entry point. Instead of purchasing an entire apartment, investors can buy a small digital share of one. Some platforms advertise minimum investments between $50 and $100, turning property exposure into something that feels as accessible as buying a cryptocurrency. Here is how it works. A property is normally placed inside a legal entity, such as an LLC or special purpose vehicle. That entity holds the actual building, while its equity or revenue rights are divided into blockchain-based tokens. If a $5 million building is divided into 50,000 tokens, each token represents $100 of exposure. However, the token itself is not usually the property deed. It represents a contractual interest in the company that owns the property. That distinction matters. Smart contracts then manage the digital side of the investment. They can verify eligible wallets, record ownership, control transfers, and distribute rental income. After expenses such as management fees, maintenance, insurance, taxes, and vacancies are deducted, the remaining income can be divided between token holders and paid in dollars or stablecoins. Ethereum and related networks have already hosted property-backed tokens. Solana also supports real estate products and faster, lower-cost on-chain transactions. But investors must check what each token represents. Some products provide actual fractional ownership, while others only track property price indexes. That difference matters. The advantages are powerful. A young investor can spread a few $100s across properties in different cities instead of concentrating everything in one mortgage. Ownership records can be viewed on-chain, rental payments can be automated, and tokens may be available for trading around the clock. Institutional interest is growing. Goldman Sachs partnered with Apex Group, Archax, LRC Group, and Onera on a blockchain-native real estate fund using Goldman's GSDAP platform. Some forecasts now suggest tokenized real estate funds could reach $4 trillion by 2035. But this is where the promise collides with reality. Being available to trade 24 hours a day does not guarantee a buyer exists. Many property tokens trade inside small, platform-specific marketplaces with limited volume. If demand disappears, an investor may be unable to sell without accepting a heavy discount. The regulations are also complicated. Property tokens are generally treated as securities, meaning investor verification, transfer restrictions, and jurisdiction-specific laws still apply. Smart contract bugs, wallet theft, unclear tax rules, platform failure, poor management, vacancies, and falling property values create additional risks. A blockchain can prove that you own a token, but it cannot repair a damaged building, remove a bad tenant, or guarantee that rent will arrive. The investment is still only as strong as the property, legal agreement, and company behind it. So, is tokenized real estate a Gen Z wealth builder? Potentially, but it is not instant, risk-free passive income. Before investing, verify the deed, legal ownership, fees, rental history, smart contract audit, withdrawal rules, platform regulation, and genuine secondary market volume. Tokenization can make real estate smaller, faster, and more accessible. It cannot make bad real estate safe.